Hi, thanks so much for joining in. You're watching the Mutual Fund Show, and my name is Alex Matthew. In this show, we try to get you actionable insights so that you can make your investment decisions with confidence and with the right kind of knowledge. Now, I don't normally talk about insurance products on the show for obvious reasons, because this show has to do with mutual funds. But today, we're going to make a bit of an exception. We're going to talk about ULIPs today, because there's a recent advertisement by PNB MetLife that might have confused some of you if you've seen it. I have it on the screen right here, and I'm going to point to a few of these aspects. This is the advertisement that has been playing out on social media and various other places, and you have the first point right here, that is NFO, that is new fund offer, and that is usually something that is associated, as you probably know, with mutual funds. The other thing that you have right here is a NAV, which is the net asset value. Again, another thing that is associated with mutual funds. What you have here is the name of the fund that is being launched, and it's called a small cap fund. But this is a ULIP that we're talking about. It's an insurance product and not a mutual fund. If I were to meet you, and if I were to say that PNB MetLife has just launched a small cap fund, and if I was to ask you which product you think it is, you would probably say mutual fund. So again, this is a little bit confusing. And right on the top, you probably can't see it because it's really tiny print. It says that in this policy, the investment risk in investment portfolio is borne by the policyholder. There is no specific designation of the quantity of risk that a potential policyholder might face here. So we'll delve into some of these aspects, and we'll discuss why something like this is such an opportune space for mis-selling, especially in the insurance space. Now, let me introduce you to my guests today. We've got Kirtan Shah as well as Prableen Bajpai joining us today, and we're going to talk about ULIPs as well as the mutual funds that might relate to this. So small cap, of course, is what PNB MetLife has chosen to use to describe their latest offering. So we'll talk about a few small cap offerings as well. Thank you so much to the both of you for joining in. Let me start, though, with a question to Prableen, you first, and then I'll go to Kirtan on this. What's your first reaction to an advertisement of this sort, where you're talking about a ULIP, but the name of the advertisement or the product is very clearly the PNB MetLife Small Cap Fund?
Good afternoon, Alex. And, I'm happy to say that we are actually discussing this topic. Yes, the first reaction is that nothing much is being done about the kind of mis-selling which is happening when it comes to insurance and investment-linked products, because the name typically definitely sounds like it's a mutual fund, and the features of mutual funds and a ULIP are quite different. Secondly, Alex, that, since the times we've been, because insurance is a very old investment and risk management tool, and most of the people associate insurance with a product which is broadly safe. Somewhere they feel that, if you're putting our money in an insurance product, all is well. And that's not the case. And when an insurance product is coming up with a small cap fund, I think it can really mislead investors, because probably somewhere in their mind, they would still have that feeling that it's going to be okay. It's kind of a guaranteed return product, which is broadly in the traditional schemes. So I think more clarity with regards to what the features are, how you're committed to paying your yearly premiums, the flexibility and other features is so required. And I think definitely just the way SEBI has been so clear, and I think each time we are seeing that more and more regulations are coming to make mutual funds a leaner, more transparent and flexible product. I don't see the same happening in the insurance industry.
Okay. Fair point. Now, I must point out that I reached out to a few people in the regulatory space, and what I've heard is that both the SEBI as well as the IRDAI are aware of this particular product, and we're expecting some regulatory action by the insurance regulator. I believe there has been discourse between the two regulators as well. I must also point out that I reached out to the company for a clarification, and what they've said is that they don't think that they are misleading investors or policyholders by their advertisement. I had to make that mention. They have clarified again that this is not a ULIP product. This is in fact a ULIP fund. And it's important that we describe why that classification is being made, Kirtan, because in a ULIP, there are two aspects to the premium that is paid. So say the 1 lakh rupee premium, there's a 1 lakh rupee premium, hypothetically, a portion of that goes to the life cover and a portion of that goes to the investment. In this case, what they're saying is that this small cap fund that they're launching is the investment component, but it can't be sold without a life insurance cover at the moment, right?
Alex, it's quite funny because like you rightly started off the conversation saying that NFO, NAVs, SIPs, these are very common terms which are associated with how the mutual fund industry operates. And because we've seen over the last 4 or 5 years how there has been so much of awareness around mutual funds and the retail investors really want to bite into the investment vehicle, I think the insurance side of the business is trying to leverage the already knowledge that is spread around the mutual fund business by using these terms. Now, very clearly, when you use an NFO in the MF side of the business, it's actually a new fund which is getting launched. But like you rightly said, I think investors here have to understand that when you put a 1 lakh rupee of premium in a ULIP product, even when you don't want to buy an insurance, there is a compulsory insurance component that you have to buy. So let's say out of a lakh of rupee that you've invested, this is just for an example, 10,000 of that will compulsorily go towards buying you a term insurance even when you don't want it. Over and above that, there are other charges like probably a policy admin charge or a premium allocation charge that gets deducted over and above the mortality cost that we just spoke of. Whatever amount remains after these charges are deducted is actually where the investments come into picture. Now, you are given a choice to select between wanting to do equity, debt, or an hybrid as a product. Now, this new ad that we are talking about is one of the funds that have got introduced here on the equity side. So as a policy, you might have a lot of funds to offer on equity, a lot of funds to offer on fixed income, and some funds to offer on the balance or the hybrid side. Now you are introducing one new fund in the equity basket, right? Is what this ad is all about. And like you rightly said, that this is just a fund which is within the equity basket, and that fund cannot be offered to you individually unless you bought the ULIP, right? So it's a subsection of buying the ULIP and not a product in itself.
That's a fair point. We've often spoken, Kirtan as well as Prableen, about insurance and the mixing of insurance and investments, and that's essentially what ULIPs are. Like Kirtan was just pointing out, Prableen, there are various options available: equity funds, income fixed interest in bond funds, cash funds, balanced funds. But the most important question, I think, is whether or not you should go for an insurance plus investment product in the first place. What do you say about that?
Again, Alex, insurance plus investment, ULIPs are the closest competitors for the retail investors' money. And what is being done is because of that little part of insurance that you get, which is 10 times of the premium. So let's say I buy a policy where I'm paying an annual premium of 50,000. I get an in life cover of about 5 lakhs. Now that 5 lakhs is no ways sufficient enough as a life cover. If something happens to me, that 5 lakh won't be enough for my family. But because of that, certain amount of tax benefits get embedded in the product. And because of that, the appeal tends to go up. And that is why ULIPs are still sold. Now we do have a limit where a premium of more than 2,50,000 a year, the tax deductions and benefits are really not there to the fullest extent. But answering your question, whether you should be mixing them or not, or these bundle products are good, ideally it should be kept separate. Whether you see in terms of sufficiency today, as a retail investor, if you are in a high tax slab or you're earning a decent amount a month, your insurance requirement would run into crores. It may be 2 to 5 crores, what you require for your family to take care of their life if you are gone. And any of these ULIPs, unless and until you're paying a very, very heavy premium, where you actually lose out on the tax benefits later, will not suffice. Secondly, that investment in itself can be just kept clean. Let's say, just buying one ULIP or having these 20 different ULIPs, where names like multiplier, optimizer, wealth are used, you really don't know where your money is going. So other than the comfort that investors get by investing in these products, I think ideally it should be a term plan. You have to have your risk management separate from your investment planning, which should be based on your goals, how much you require for your child's education, your retirement, your travel, and other things. And ULIPs can definitely be bought by investors, but they have to be sure about what purpose are they meeting for the investor, and where do they fit in the overall portfolio for the investor.
One of the points that you mentioned, Prableen, has to do with the tax aspect of it, and I think there was an attempt to correct what was seen as a bit of a gap between equity-oriented mutual funds and equity investments as a whole and ULIPs, but there still is a tax advantage. So, Kirtan, why don't we lay that out? And after that, I do want to talk about the issue of the lock-in period. But first, let's talk about the tax aspect and whether or not that's enough of a reason to choose ULIPs.
Alex, there are three things to look at while we talk about taxation to do with ULIPs. First, of course, is up to 1.5 lakhs, the premium that you are paying. You can claim that as a deduction under ATC. Exactly the same way probably while you do an ELSS in a mutual fund, right? Also, if your premium is 10% of your sum assured, or the other way around, your sum assured is 10 times of your premium, which means if your premium is 1 lakh of rupee, your sum assured is 10 lakhs. If that's the situation, then the maturity amount is also tax-free. But this is conditional to your maximum premium not exceeding 2.5 lakhs, which means 2.5 lakhs is the premium that if you invest in ULIP, and you have a 25 lakh worth of sum assured, in that situation, your maturity amount is tax-free. And of course, that's a very large advantage that the ULIPs still command over any other products in the same category. But I think, like Prableen was also mentioning, that probably this is for a very small set of audience who probably does not have an insurance or does not do any investment, and hence that 2.5 lakh of yearly investment probably might look interesting. But the day you cross this 2.5 lakhs of ULIP total premium investment, either in one policy or in multiple policies, your maturity value ends up getting taxed, right? So if you've taken equity fund, you will be taxed at 10%, and if you've taken fixed income fund, you'll be taxed at 30%, or your slab rate, whichever that turns out to be. So over 2.5 lakhs. Probably this largely has no real advantage in terms of taxation.
We've broken from the norm, and we're talking about the insurance industry. In fact, we're talking about a ULIP that has been labeled as a small cap fund, and this is because the PNB MetLife small cap fund that we've been discussing both today as well as yesterday. Now, Prableen, a hypothetical scenario, because this occurs quite often. You get a call from somebody from your bank and they say, hey, you know what, Prableen, we've got this new product that is available. It is the PNB MetLife Small Cap Fund. And you should invest in it because it's a great new product. You're getting it at an attractive NAV of 10 rupees. This is an introductory offer available till the 29th of February. The issue here is that you don't necessarily know about the lock-in period that is available for 5 years. Why is that a big red flag?
Absolutely, Alex. And the sad part is that the timing of the product launch, because we've already seen small caps do so well. And I think very recently, even Kotak Small Cap Fund has, put a ceiling on the amounts that they would be taking in the small cap fund. So, of course, it's an overheated space, and this is the best time to sell a small cap. But coming to your question on why the lock-in is a red flag. So with any mutual fund products, Alex, I can, start an SIP if I lose my job or for some other reason I cannot pay my SIP or I want to reduce my SIP. It's very, very easily possible. And if I want to discontinue it, I can just, stay invested with, let's say, the 12 SIPs that I had done, or 5 SIPs, 7 SIPs I had done in the fund. So it stays invested in that particular small cap fund, for example, and it can continue to grow. When it comes to an insurance product, a ULIP, if you stop paying the premiums, because a lot of people are sometimes not aware that, let's say, this 2.5 lakh is not a one-time thing that they need to do. It's the recurring charge, a premium for the next 5 years. And if they want to stop investing, what happens is this amount moves into the fund, discontinuous fund, and there they are only earning returns which are equivalent to your savings bank account. And the money will also come back to you only after a 5-year period. So one really has to be sure whether you can, stay committed with that money. If you can actually keep putting it in the fund for the next 5 years. And the other problem, what happens is, Alex, that sometimes, because people, of course, you don't want to sort of surrender the policy or discontinue because, there are charges involved. They stop all their better investments, or they start sacrificing on other things because now they need to pay this huge premium that they're committed to. So definitely the biggest red flag, and that is why complete information about a product is so needed.
Okay. The last point on this, and I will take one viewer query that has come in, but Kirtan, most importantly, suppose somebody is stuck in a product that is not necessarily the best for them. We've just heard Prableen lay out what happens in the event that you realize this, and if you stop paying, it gets into a situation where you're a little stuck. But is it better to not pay and to say, okay, that's something that I will lose, and then switch over to better instruments or investments in this situation? What's the best thing to do?
So Alex, this is very individualistic, because
Sure.
you will have to understand what the premium is, which year in the cycle are you stopping, how much have you accumulated, and if you surrender the policy, how much are you going to get back? A lot of these calculations will keep changing depending on at what point in time and for whom are we talking about. But even if we have to still generalize this, I would rather say that, if you are very early in the investment, you are better off letting go of some part of it, because they will cut some charges and give you back a little as surrender value. Because the longer you want to stay invested, right, the compounding effect will kick in. And if you're in the wrong product, the compounding will not work for you. You might as well want to move to a better product where the compounding starts working for you, then against you, because of the charges of the product. So though it is individualistic, but if we still have to generalize, I would rather say that you want to get out of the wrong product and make sure that you move into the right product, even if that comes at a cost of some charges to you.
All right. And the bottom line, of course, is try and separate insurance from investments. And we've been talking about mutual funds quite often. This is something that you should consider, but we'll get to that in just a bit. I promised to take one viewer query, and this one is coming in from Ravi Agarwal. He says that he's 62 years old. He gets a pension of approximately 2 lakh rupees per month net of tax. He doesn't have a precise figure of monthly expenses, as his wife and him have lived in the UK and UAE for the last 30 years, but he guesses that his monthly expenses, including health insurance, will be covered by the pension amount. They would also like to use about 1 lakh per month of the same pension amount for travel and other expenses. They don't have mutual fund investments right now, but they have about 8 crore rupees in NRE fixed deposits. They're looking to return to India soon and would like to invest that 8 crore amount in mutual funds and other investment tools to generate between 10 and 12%, which I think is a reasonable amount to expect. What funds would you recommend at the onset? So, Prableen, how would you recommend getting, just started on something like this?
So, Alex, because once they move back to India and the tax status changes, the benefits of keeping money in your NRE and NRO account won't be there. So for him, I think, yes, moving into mutual funds will be a good idea. Let's say if you're looking at 30 years into retirement, it will be nice to have some sort of tax efficiency and inflation-proof portfolio. So definitely for him, I think start with a mixture of large caps along with a mid cap fund, and I think along with that a hybrid fund can be picked for him. The portfolio would, the allocations would depend, I think, on what kind of a risk appetite they have, and I think clubbed with that, even debt funds at this point, locking in into state development loans and the combination with government securities, I think that can also work well for them. I think the accurate structure would depend on the discussion.
Any quick names of schemes in the categories you mentioned?
So I think in the hybrid space, something like a balanced advantage or a multi-asset from SBI, ICICI, the more credible fund houses, HDFC. In the large and the mid cap, I would say just simply go with a Nifty 50 equal weight, and the mid cap, I would say again an index fund because we are looking at a 25-year horizon.
Fantastic. All right. Prableen as well as Kirtan, thanks so much for joining in on this slightly different edition of the Mutual Fund Show. It's been a pleasure, as always, speaking with you. And viewers, hopefully this conversation has been beneficial to you. Write to us on any one of our social media platforms to tell us what you think. There's lots lined up over the course of the day. This is NDTV Profit.